It is New Year's, everybody. Well, New Year's was a few days ago, but Happy New Year anyway. We are going to talk about some of our favorite stocks, not just to buy, but to sell right now. 2023 was a generally good year for the stock market, but some stocks on our radar doubled, tripled, or even a lot more, as you're about to hear. Before we dive in, please take a minute, click subscribe to my channel, and check out the link you see on your screen for a special message from my sponsor, The Motley Fool. It's the best way to support this work Tyler and I are doing on YouTube. So, without further ado, one stock that I think might have gone a little too, the market might be a little too optimistic on is iBuyer Opendoor, ticker symbol
Maybe just a little.
OPEN. Maybe just a
Maybe
little.
just a little.
Now, I mean, Tyler knows that no one believes in the iBuying business model long term more than I do. I've talked about it many times on the show that I think the way we buy and sell houses does need to evolve a lot. We're not really there yet. Opendoor is the leader in the space. They're one of two pure play iBuyers, with the other being OfferPad. Opendoor is up 239%, or was in 2023. And the general reason is that the real estate market didn't turn out as bad as people thought it would. And credit where it's due, they executed pretty well. Gross margins were better than expected. Contribution margins were better than expected. The newer homes that Opendoor's bought are profitable, at least on a gross margin basis, whereas the houses they bought in 2022 and earlier, let's just say that they overpaid for, and have like negative 10% gross margins in a lot of cases. So the business is looking better than before, better than people expected. That's why the stock has more than tripled. But on the other hand, the stock has more than tripled, and this is still a business that's losing money. In my mind, there's a few reasons why I would get rid of Opendoor and just take my profits, especially if I'm up in the stock. For one thing, they have a lot of inventory, and a lot could still go wrong in the real estate market. There's a lot of uncertainty in the U.S. housing market right now. Yes, it will be great if mortgage rates drop to 5% this year. Is that going to happen? Who knows? Mortgage rates could rise back to 8% just as easily, and we'll have a terrible real estate market. Home prices could crash if we hit a recession. There's a lot that can go wrong, and if you have $1.3 billion of homes on your balance sheet, $2.8 billion in debt, and a lot can go wrong there. There's just, in my opinion, more that can go wrong than correct for Opendoor in 2024. So that's why I am a seller of the stock. Tyler, correct me if I'm wrong, but I don't think you're an Opendoor fan.
Oops, muted. No, not in the slightest. Let's just throw some third quarter numbers out here. In the third quarter, its revenue was down 70% year over year. The most profitable segment in all of Opendoor's entire financial statements is the interest that it gets on its cash pile. That's where the only real net benefit that you can actually see the company making money is basically because treasuries are at 5%. Part of the whole business of buying is that you have to buy and sell houses, not just buy them. And they have just basically been drawing down inventory to lower debt, but the value on those inventories was lower than what they purchased them for, and then all of a sudden they have more debt than they can even cover with their cash position. So like you said, the future of this business is somewhere in the realm of not what it currently is, but I don't think Opendoor is the solution.
Yeah, the way I would sum it up is I think in that 2020 to 2022 growth at all costs period, where they racked up all the debt that we're talking about, and you mentioned they revenue declined over 70% year over year. It's because they were buying houses at any price, whatever they could do, and selling them into a hotter market than we've ever seen in history. I kind of feel like they did irreparable damage to the business during those periods. And the numbers, if I'm looking at the balance sheet, their assets, everything like that, just does not make sense to me right now. So what I would do, if you want to stay in the real estate technology space, I'd roll the money into a company called Redfin, which, if I'm not mistaken, Tyler hates slightly less. But it's one of my favorite stocks as we go into 2024. Redfin is only up by 122% in 2023. But there's kind of like I have like a three-part thesis on Redfin and why it is a good buy right now. Um, Number one is the most obvious: improving real estate market. We've already seen interest rates come off their peak in October. They've fallen from 8% to a little less than 7% since then. And we're already seeing that play out in the form of increased mortgage activity, which generally means more real estate activity. If interest rates could continue to fall throughout 2024, as most investors expect, it could be a big catalyst for the real estate market and drive traffic to Redfin's site, create more sales for its agents, create more business for its mortgage arm, etc. So that's number one. Number two, Redfin has done a great job of getting rid of businesses it doesn't need, like iBuying. It had its own iBuyer, Redfin Now, and it quickly pulled the plug before it got too big, unlike Zillow, who let it kind of spiral out of control to a big money losing business. They've really focused on profitability, made some difficult decisions in terms of downsizing their staff, and really are on the verge of profitability almost. They went from a $90 million quarterly net loss a year ago to about $19 million. They're profitable on an adjusted EBITDA basis, which I know is, we all know what Charlie Munger said about adjusted EBITDA. Look it up if you don't know, because this is a family channel. But they are kind of making strides toward profitability. It's an impressive transition in just a year. Um, and last but certainly not least, we're seeing a war on brokerage fees that is a could be a net positive for Redfin. Essentially, the argument is that realtors are keeping fees artificially high by forcing the seller to pay both their agent and the buyer's agent. If buyers have to pay their own agent, would you actually write a check for 3% of the sale price of the home that you're buying? Probably not. Or you would at least try to comparison shop a little bit more. A fee pressure is good for Redfin. A technologically efficient platform is good for buyers, sellers, and their agents. If buyers decide to go it alone, Redfin has the technology to help them do that. And it could just be a really good thing for Redfin and a negative for Opendoor, which a lot of people don't realize. Opendoor charges a 5% real estate commission. If they make you an offer, you're going to pay 5% off the top of that in a sales commission, which they quote similar to how an agent takes a commission in a traditional sale. So fee pressure could be a net negative for Opendoor as well. And last, one more kind of tidbit before I, stop talking. Redfin could be a beneficiary if Opendoor wins. Redfin partners with Opendoor to generate leads for them and gets income from that way. So I think more can go wrong for Opendoor than Redfin, but if Opendoor ends up being a winner, it is also likely to be a net positive tailwind for Redfin as well. So, Tyler, am I right? Do you hate Redfin slightly less?
I hate it less. I think it's running into some operational issues. I think that the iBuying that it tried to do, similar to Opendoor, caused some almost irreparable damage to the balance sheet that it's going to take years to repair. And part of this operational blocking and tackling, like you speak about, the thing that I have a little bit of concern with that is that in even though we're in a declining market, the sign that that is working is they should be taking market share, and that doesn't appear to be the case yet. And so until we start to see them taking market share, that's where it starts to, that thesis doesn't quite hold water with me as much. I'm not saying it can't happen, but that for me is, I want to see that happening first before I'm going to change my mind on it. Now, we can maybe tease perhaps an idea for a later video, but if you wanted to go something that's a little bit more established and kind of knows what it does in a similar vein, CoStar is out there and could buy Opendoor and Redfin and still have a lot of walking around money based on its cash pile. But that's probably a video for another time.
Yeah, I definitely think out of the two, I actually think Opendoor would make the most sense as a takeover target for a company that has the resources to clear up that balance sheet and kind of right size the business in an economical way. Because Opendoor doesn't have the luxury of picking and choosing its opportunities at the moment. It has too much debt. It has to generate a certain amount of revenue in order to keep servicing its debt, and it's not a great environment to raise capital. I mean, with the stock tripling, it's better than it was. But even so, once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.